Welcome. My name is Rich Cagle, and I'm with Cypress Business Brokers. We're located in Houston, Texas, and serve Southeast Texas. We help entrepreneurs realize the value in their businesses. This is part 4 in a series devoted to taking the mystery out of business valuation. In our previous episodes, we covered some of the basic concepts of business valuation. We talked about the 3 basic approaches to valuation, and then we covered the concept of present value and discounted cash flows. In this episode, we're going to introduce financial statement analysis. This presentation contains general information about the valuation process. However, it is not intended to give you advice about your own particular situation. You should always consult with your own advisors and should engage a qualified professional to assist in any valuation assessment. So what do we mean by financial statement analysis? A company's financial statements can tell us a lot about what's going on in the business. Beyond just looking at net income, we can get a feel for how effectively the company is using its assets. Is its capital structure appropriate for the business? We can evaluate some of the financial risks the company faces and dig a bit deeper into profitability. The better we understand a company's financial statements, the more confidence we can have in future results. As an investor or buyer of the business, reducing uncertainty can give us confidence in making the investment or purchase. Before we can begin to analyze a company's financial statements, we need to know the environment in which they were prepared. Financial statements of publicly traded companies in the U.S. must be audited by an independent public accountant and must comply with the requirements of generally accepted accounting principles, or GAAP, along with the rules and regulations of the SEC. Privately owned companies, however, have much more flexibility. We need to know what basis of accounting was used in preparing the financial statements. Generally accepted accounting principles is the preferred method of accounting. GAAP will ensure that financials are comparable from period to period as well as to other companies. GAAP also requires comprehensive disclosure via the footnotes of information useful for understanding the financial statements. Sometimes we'll see financial statements prepared on another basis. The income tax basis is fairly common for smaller privately held companies. Some other bases could be government GAAP or international financial reporting standards. Sometimes smaller entities will use the cash method of accounting. Under the cash method of accounting, sales are booked when cash is received. So if a sale was made on credit, we wouldn't record it as a sale until the customer paid the invoice. Similarly, expenses are not recorded until they're actually paid. Most importantly, we need to know whether whatever accounting rules being used have been applied consistently for all statements. If the accounting is inconsistent, then our ability to learn anything from the financial statements is seriously limited. Let's take a minute to talk about what levels of assurance we might seek for financial information. The lowest level of assurance would be financial statements internally prepared by the company with no outside oversight. While the financial statements may in fact be perfect, we would want to spend some time asking questions and looking at documentation to assure ourselves the data is reliable. It'd be advisable to seek expert advice here. The next level would be financial statements compiled by an accountant. In a compilation engagement, the accountant would compile a company's financial statements from the company's own record, but would not perform any testing or analysis. The accountant would offer no assurance that there are no material misstatements or errors. In a review, the accountant would perform some limited testing and analysis and would give limited assurance that the financial statements are presented under the requirements of the chosen basis of accounting. The highest and most expensive form of assurance would be an audit. The auditor would express an opinion giving reasonable assurance that the financial statements are fairly presented under the requirements of the chosen basis of accounting. Due to the expense involved, audited financial statements are unusual for smaller, privately held companies. So let's look at the 4 basic financial statements we would expect under U.S. GAAP. The balance sheet, or statements of financial position, lists the company's assets and liabilities. Categorized. Owner's equity is the difference between company's assets and its liabilities. Generally, items are stated at historical cost or at lower cost or market values. We'd have to read the notes to the financial statements to tell whether the company used any mark-to-market accounting. Current assets are assets that will be consumed within one business cycle, typically 1 year. Current liabilities are obligations that must be satisfied within the same business cycle period. For the rest of our discussion, we'll assume the business cycle is 1 year. Current assets and current liabilities are often referred to as working capital, and current assets minus current liabilities as net working capital. Fixed assets, in this case equipment, is depreciated. That is, a portion of its acquisition cost is written off to expense each year. Income statement, or statement of earnings, tells us about the company's revenues and expenses, measured and recorded according to the adopted accounting rules. Income statements can be for any period of time, a month, a quarter, a year. In this example, we have 3 annual income statements for comparative purposes. You recall from our earlier discussions that net income is not the same thing as cash flow. It includes non-cash charges like depreciation expense. The statement of cash flows is probably the least understood, yet potentially the most useful of the financial statements. In the top portion, operating activities, we see the effect on cash of variations in working capital items. If accounts receivable increase, for example, it means that some of the sales we reported on the income statement, which are included in net income, have not yet been collected in cash. Cash flows from investing activities will show us when we bought fixed assets, in this case equipment. We can see we bought $12,000 in equipment during year 2011. And up in the operating activities, we see $2,000 in depreciation expense during the year. This corresponds with the $10,000 in equipment reported on the balance sheet. Cash flows from financing activity shows us the effect on cash of changes to the capital accounts of the business, specifically long-term debt and owner's equity. We see the owner put $2,500 into the business in year 2010 and borrowed $10,000 during 2011 and repaid $2,000 of that loan during 2012. Earlier, I referred to the notes to the financial statements, often called the footnotes. In the notes, we can learn some of the details about the company's leases, long-term debt, fixed assets, and significant accounting policies. If footnotes are available, they should be read carefully. So now we've defined the basic financial statements, let's begin some analysis. One of the most powerful tools to analyze financial data is ratio analysis. A ratio is just one number divided by another. It's a way to compare results on a common basis. Probably the most familiar ratio we encounter is miles per gallon as a measure of fuel economy in the car. If we're comparing two vehicles and we're told that vehicle number 1 used 10 gallons to travel 200 miles and vehicle number 2 used 5 gallons to travel 120 miles, it isn't real obvious which is most efficient. But if we instead use the ratio of 20 miles per gallon for vehicle 1 and 24 miles per gallon for vehicle 2, we have a way to compare them. Some of the most common uses of ratio analysis is to look at liquidity. That is the availability of cash to satisfy the company's obligations. Capital ratios will give us insight into financial leverage. That is how much of the business is financed with other people's money as opposed to the owners. Some of the profitability ratios will give us insight to how efficiently the company is in the sense of generating earnings from its assets. Again, the benefit of ratio analysis is it gives us a way to compare companies of different sizes against each other or to compare a given company to benchmarks. Probably the biggest risk a company faces is running out of cash. Liquidity is the way to measure how likely that event is over the next year. Liquidity ratios not only give us insight into the company under analysis, but can be compared with benchmarks and/or other companies. The current ratio is defined as the company's current assets divided by its current liabilities. You could think of it as an answer to the question, if I had to close the business today, do I have enough liquid assets to satisfy all the obligations that would become due in the next year? As a rule of thumb, the ratio should be greater than 1-to-1, although there are exceptions. Looking at our example balance sheets, we can see this company is extremely liquid, and its liquidity is increasing. The asset test ratio is a bit more conservative. It says, let's assume our accounts receivable and inventory are worthless, so we still have enough cash to pay for all our current liabilities. Again, this example company is very liquid. Liquidity should be looked at in relative terms. While being highly liquid is safe, it could also mean we have cash and other assets that are not being invested in a productive way. We have to look at high liquidity in relation to the strategic plan of the company. Is it planning an expansion? Or is it being defensive against a new competitor? Or is it just overly cautious? Accounts receivable levels are an important indicator of the quality of the company's customer base. A company may have high reported sales, but if it has trouble collecting payment, it could eventually lead to a cash shortage. The turnover ratio tells us how many times the receivable balance was turned over. That is, a sale made and collected during the year. For example, if a company sold products on 30-day terms, we would expect the turnover ratio 12, 365 days in the year divided by 30-day terms. Looking at our example company, we can see that turnover is healthy and increasing. This could be due to shortened terms. Some of his customers may have terms shorter than 30 days, but in any event, it looks pretty good. Days sales of receivables tells us how many days of sales are uncollected at the balance sheet date. It's simply the ending accounts receivable balance divided by the average daily sales. Inventory is often an item on a company's balance sheet. If a company has inventory, it must use the accrual method of accounting, at least for tax purposes. A significant risk is that obsolete or unsaleable inventory is allowed to accumulate instead of being marked down or written off. Inventory turns, that is the cost of goods sold over a year, divided by the average inventory, gives us a feel for how long the inventory has been around. Similar to days sales in receivables, days sales of inventory on hand is a way to evaluate inventory on hand in relation to the company's sales. In our example company, we can see that at year-end 2012, at our current average daily sales rate, it would take us just over 3 months to sell all of our inventory. This could be peculiar to the industry we're in or be seasonal, but we would probably want to focus on inventories a bit more if we're considering buying this company. Leverage ratios give us a way to compare earnings to the obligations of the company. To give it some perspective on the risk of financial leverage, interest coverage ratio, defined as net income divided by interest expense, helps us understand how much leeway there is before a company would be unable to meet its interest obligations. Lenders in particular are very interested, no pun intended, in interest coverage ratios. If we're contemplating buying a company with debt financing, we would need to have some comfort on interest coverage. Fixed charge coverage ratio is a bit more conservative. It uses all fixed charges such as interest payments, debt repayments, leases, etc. as the denominator. Profitability ratios give us perspective on how much of a company's activity falls to the bottom line. That is, how much results in profit. Gross profit is a way to measure a company's sales pricing compared with its cost of product. Gross profit is the difference between sales and cost of goods sold. If we divide gross profit by sales, we get the result gross profit percentage. In our example above, 57% of each sales dollar was available to pay expenses in 2012. Return on sales relates sales to net income. It's simply net income divided by sales. In 2012, we can see that just over 19% of each sales dollar was profit. This is an extraordinary result for most businesses. To be useful, we would need to compare these results with other companies in the same industry. Another way to look at profitability is to relate it to either assets or to the equity capital invested in the business. Return on assets, net income divided by average total assets, is often used to evaluate whether or not the company is productively using its assets. A low return on assets with an otherwise acceptable return on sales, for example, could lead us to investigate whether there were underutilized assets in the business that could be sold or invested elsewhere. Return on equity, sometimes called return on investment, is the company's net income divided by equity capital invested. In our example company above, the owner earned a 55% return on his investment in this business. Return on equity should be considered in light of the company's financial leverage, which we'll see in a minute. We've used the term financial leverage. Let's define it. First, we need to define the term capital structure. Capital refers to the funds invested in a business to pay for its assets. Capital is typically comprised of debt and equity. Leverage refers to the relative amounts of debt and equity in the capital structure. Like a conventional lever, we can magnify the results achieved by moving the fulcrum, that is one side of the lever. Think of a seesaw. If the seesaw is evenly balanced, then we can say there is zero leverage. A child on one side would remain forever in the air if an adult were on the other side. But if we unbalance the seesaw, that is, increase the leverage for the child, then the child will be on the long side and they'll be able to balance the adult on the short side. It works the same way in finance. As we borrow more money, we need to invest less of our own money in the business. Note that leverage works both ways, however. It can magnify profits, but it can also magnify losses, and hence the risk. Debt equity ratio is a way to assess financial leverage. It's simply the company's debt capital divided by its equity capital. If a company had no debt, its debt equity ratio would be zero. If it was financed equally with debt and equity, its debt equity ratio would be 1.0. From our example balance sheets, we can see that our company has been deleveraging during 2012. That is, its debt equity ratio has declined as it's repaid some of its debt and its equity increased from earnings. Here's an example of financial leverage. For this example, I assume the company earns $20,000 before interest expense and has total capital of $100,000. With zero debt, the owner earns 20% on a $100,000 investment. As we increase debt, our net income declines due to interest expense, which I assume to be at 5%, but our return on equity increases. With a debt equity ratio of 1, for example, net income is down to $17,500, but we only have $50,000 of our own money invested, so we earn 35% on our investment. Some final thoughts. Financial statement analysis can be a useful tool to reduce the risk of buying or investing in a business. It can point us in the direction of potential problems and give us some assurance as well. Its use is predicated on having accurate, consistently prepared financial information. If we're a business owner, one way to increase the value of our business is to ensure that we have reliable, timely financial information. Financial statement analysis is a tool that can be used by an investor in evaluating a prospective investment, and also by a company's owner or manager to pinpoint issues that require further attention. Thank you for your time today. I hope this has been informative. In previous episodes, we discussed some of the basic concepts behind business valuation analysis and some of the methodologies used, and paid particular attention to the concept of present value and discounted cash flows. In this episode, we introduced some of the concepts of financial statement analysis. Stay tuned. We'll continue to offer presentations that I hope will be useful to you. If I can offer any assistance, please feel free to contact me. Visit us on the web or on Facebook. I'd love to hear your comments and any suggested topics for our next program.